Hi, everybody. This is Hyperwave. We have Tyler on today, and this is going to be more of a fireside chat. Tyler's going to go into the 12 principles that we have of investing at Lucid, what he thinks about. I have no idea what they are right now. I do, but I have no idea what he's going to say today. And so, therefore, he wants me to be crazy and ask all the important questions and call him a crazy man. And you guys already are sending in really, really good questions. I can see them. I'm going to write all of them down, and if we can't get to them today, we're hoping to do another show tonight or tomorrow where it's just Q&A for all your questions. So with that said, I will throw it to Ty right now.
Great. Good morning, good afternoon, good evening. We've had a lot of questions about moves that we have made, and those of you who have listened to 150 of our vlogs and a bunch of our webinars really don't have the same questions that we're getting from people that have just listened to a couple of things or read some tweets. We have talked about all of our principles of investing, but not in one place at one time. That's what we're going to do today. I've just written down 12 of them, but everything we do are based on these 12 things. Now, you've heard Leah and I talk about using little phrases, Wall Street phrases and metaphors and stuff, things like the trend is your friend. But understanding what that really means is really important. We talk about a hierarchy of time, that longer time periods are more important than shorter time periods. Longer trends are more important than shorter trends, and all of that sort of thing. But I'm going to try to put it all in perspective today. About 13 years ago, 12 or 13 years ago, Leah's brother and my son founded Lucid Investment Strategies. And they came up with the name Lucid Investment Strategies. Now, they had both worked as interns for me when I was doing institutional money management. And they summarized what they had heard over 2 or 3 summers of working at the bank where I worked. They summarized it all by the term Lucid Investment Strategies. And everybody knows what lucid means. It means very simple but very clear, very easy to understand. And so I loved it, because that's after 40 years of trying to figure this crazy investing thing out. I tried to simplify everything and put it into simple terms and rules. I don't always follow them, nor does anyone else in the world. But to the extent you do follow them or keep them in mind, the results are always better than if you don't. So with that as just kind of a preamble, I'm going to just list 12 things, word for word. And I would suggest writing them down. You wouldn't be listening to us if you weren't interested. And this will be a way, we will put all 12 of these on our website under principles of investing, which we don't have now. We talked about general things, but we will actually list these 12 things. Now, what I'm going to do is I'm going to read one of them. I'll start with number 1, and then I'd like to get Leah's input on it from her perspective. She and I have been working together for a year and a half, and we talk about all of these things, but I'd like to hear her interpretation or questions or observations about each of these. We're not really going to take questions right now from the audience. It will just be a discussion between Leah and myself, but she will be writing down all of your questions, and then we're going to do a second show, and all we're going to do is take your questions and answers on everything, price of Bitcoin and all the rest, but specifically on these topics, just so it's clear to everybody exactly what we're talking about. Number one, in terms of my investing principles, is very simple. Cash is king. I would rather be in cash than any other asset class. Now, I've got a caveat to this. Number one, cash is king. And that caveat is, unless an asset class is trending. So cash is king unless an asset class is trending. So that's number one. I've got a caveat to that caveat, which is cash is king unless an asset class is trending up. UP, the word up. Cash is king unless an asset class is trending up. That is the first principle of Lucid. And Leah, do you have a observation? An observation? There she is.
Observation regarding what, Tyler?
That first principle.
No, I think we're good so far. Keep going.
Okay. Number two is all asset classes trend up and down. All asset classes trend up and down. That includes cryptocurrencies. That includes Bitcoin. A lot of people didn't believe that, but I'm hoping that those people that have experienced the last year and a half realize now that it does not matter what the asset class is, it trends up and down. Going back to number one, unless an asset class is trending up, cash is king. And I will go into detail of why that is, as opposed to trending up or down in some of the other principles when we get down to them. Leah, any thoughts on that one?
Keep it coming.
Okay. Number three, trends. Remember, number one was cash is king unless an asset class is trending up. Number two is all asset classes trend up and down. Number three is trends are short, days or weeks, intermediate, weeks or months, and long, months or years. So principle number three is, don't just talk about something is in a trend. Be precise. Are you talking about a short-term trend, an intermediate-term trend, or a long-term trend? And you'll see why as we go through the principles. But it's important to understand that just saying something is in a trend is irresponsible. To say that Bitcoin running from 3,000 to 6,000 is a trend is meaningless. To say that Bitcoin is going from 3,000 to 3,200 is a trend is meaningless. You've got to identify your time frame so that you can identify the tools that you are using to describe that trend and that time frame. So number three is trends are short, intermediate, or long. You can have your own definitions. That's Lucid's definition. Anything on that, Leah? Number 3?
Regarding downward trends, do we ever short?
That has to do with number 1, which is cash is king unless an asset class is trending up. There are times that you want to take advantage of a trend that is down, but it is not the equivalent of investing in a trend that is up. It is far more dangerous, far more difficult. It can be done, but that's not one of the main principles. You'll see as we go lower into our principles why I say that. Okay, number 4. Only long-term trends are investments. Only long-term trends are investments. Any reaction to that, Leah? We've never talked about that before, but I've gone all around the barn talking about why that is true, but now I'm stating it as one of our principles. Only long-term trends are investment.
Sure. Socrates comes on, and we've often talked about trading hyperwaves and trading those long-term trends. Can you just explain a little bit more in minutia of what you mean between trading and investing, given we're still trading off of these long-term trends on Hyperwave?
Well, the word trading is not really an investment term. Trading means buying or selling. It has nothing to do with what you're attempting to achieve in terms of either speculation, gambling, investing. Now, the range of things you can do with number 1, cash is king, we've talked about in great detail before. The reason cash is king is because it just sits there and doesn't do anything. It doesn't go up or it doesn't go down. As soon as you put it into an asset class, you have to determine what you're trying to achieve. You can try to speculate on an asset class by taking money out of cash and putting it into Tesla stock right before earnings because you believe they're going to be good earnings. And what you want to do is you want to get a pop and then jump back out. That is not investing. That is not swing trading. That is not position trading. That is gambling. What you're doing is you're trying to make a determination if on the roulette wheel, red's going to come up or black's going to come up. You might be right, you might be wrong. It has nothing to do with investing. The word trading simply means getting in or out of a position. It doesn't mean how long you're going to hold, what your objective is, what tools you're using, short, intermediate, or long term. It simply means you're taking money from cash and putting it into something. It's not a pejorative term. It's not a positive term. It's not a negative term. It's the action of moving money from cash into an asset. So people misuse that constantly on YouTube and Twitter. Why are you trading? What did you trade this for? What did you trade that for? That's not specific enough to understand or to communicate what you're trying to do, what the principles are. To do that, you've got to talk about trends. I am putting money from cash into Bitcoin and I'm never going to sell it. That is an investment because you're talking about a long time period. It's a stupid investment because you are ignoring principle number 2 and 3 that all asset classes trend up and down, and you're eliminating the reality that what you are saying you're going to hold forever can trend down. So that's different than trading. Okay. Only long-term trends are investments. That's number 4. And your question was, well, what about when Socrates is talking about trading in Bitcoin? He's not talking about investing. He's talking about either speculating or doing a position trade or doing a swing trade that's a short or intermediate time frame, not an investment. If he is talking about investing in Bitcoin, you're talking about for many months or many years, and then you've got to clarify what you mean by that. So part of what we're doing today is definitional, but it's very important. It's everybody has their own definitions, their own thoughts. But when you communicate those thoughts to a second party or a third party or a broker or your husband or your wife or a friend, you have to be lucid about what you're doing, how you're saying it. And that's what these principles are based on. Okay, that's number 4, that only long-term trends are investments. That doesn't mean that you can't speculate and have that turn into a position trade and have it turn into a possible swing trade and then have it turn into an investment. You can do that if a short-term trend turns into an intermediate term trend and then turns into a long-term trend. But until you've identified the long-term trend, you are not investing. Now, I'm going to go a little bit deeper into this on a probability basis, running from impossibility to certainty. An investment is always done on the basis of something greater than 50-50. 50-50 is a coin flip. Speculation, swing trading, and even most of the time, position trading is less than a 50-50 proposition. Investing is always greater than a 50-50 proposition, or you don't do it. You want 50, 51, 55, 60, 65, 70, up as high as 80% probability in what you are doing. And the way you do that is through a long-term process where you've identified a long-term trend. That does not mean you can't make money through money management and proper tools on any of those shorter time frames. It simply means until those shorter time frames have developed into something longer, months or years, in which both the technicals and the fundamentals back you up, you are not an investor. You are not investing. And this is not simply dictionary definitions. This is the practicality of you psychologically knowing what you're doing when you're transferring money, hard-earned money, your personal wealth out of cash into another asset class. Okay.
Tyler.
Yes.
Okay. Couple questions. One, when we talk about cash, are we talking about USD? Or what about if you're in a country that you're worried about inflation?
Cash is cash. Cash is whatever you have that you can deposit into a bank and it will sit and it will not change its value except if the underlying currency is changing. Obviously, if you're in Turkey, if you're in Argentina, if you're in Venezuela, your cash is far more volatile than if you would put that into US dollars or into British pounds or into the euro. That's a different question. We're not talking about inflation or deflation. We're talking about liquidity of taking hard-earned dollars. If it hasn't been bartered for, your work or your service can have been bartered for a good, some other good or commodity that you would rather take than cash. But just know that if you take anything other than cash, it is far more volatile than cash, even cash in a currency that has a tendency to either inflate or deflate. Because the thing you took for your hard-earned dollar is designated in that currency. Therefore, if you bought bread with it, with that cash, and you haven't eaten that bread can devalue tremendously relative to a currency. Look at what happened in the Weimar Republic. So cash is that thing that you are paid for rendering a service or a product that is the most liquid thing that you can get, that does not vary in price relative to all other choices you have. Someday we hope Bitcoin will fall into that category. Bitcoin does not fall into that category even close at the present time. Okay, let's go on to number 5. Long-term trends. Remember 4, only long-term trends are investments. Number 5 is long-term trends all contain short and intermediate counter trends. All long-term trends contain short and intermediate counter trends. A long-term bullish investment in a trend will have within it over time counter trends that go against the main trend. Those are not opportunities for investing because they're short or they're intermediate. If a long-term bull trend turns into a long-term bear trend, then you have the opportunity to invest in the long-term bear trend. And you can do that by shorting. You can do it by buying inverse funds. You can do it in a number of ways. But it is more dangerous than long-term uptrends, which is why I specifically said in number 1, cash is king unless an asset class is trending up and not both up and down. Sometimes it is better to forego trying to play a long-term downtrend rather than being in cash. And that's a whole subject for a webinar and other things. All right, so number 5 is be prepared once you've made an investment for that investment in a short or an intermediate term time frame to move against you without changing the fact that it is still an investment. There are tools such as Consensio that helps you understand that principle, but you've got to apply it. You've got to understand what it is and how it works, which is why Leah and I have spent a lot of time doing vlogs about each of these topics. Plus, we're beginning to build a library of webinars that go into an explanation of why these topics or principles are so important. Okay, that's number 5. Number 6, loss of money, loss of cash, loss of wealth is not equivalent to a loss of opportunity. It is 100 times more important than a loss of opportunity. What that means is if you are sitting in cash and you've got 100 different opportunities to buy something with that cash, your decision to do that is 100 times more important than your decision not to do it, because you will have 100 or 99 more chances to put that cash to work. As soon as you put that cash to work, it is at risk. And the risk of losing some or all of that money is on the table. Losing an opportunity costs you nothing, which will be part of the answer when we get down to why do you make decisions at certain times when you've got two conflicting or three conflicting signals telling you what you should do. And the answer to that is number 6. A loss of money is not equivalent to a loss of opportunity. And it is astonishing to me how few people in the crypto world understand that. Number 7, a 50% gain is not an inverse equivalence of a 50% loss. That is the single most important rule or principle that Lucid uses in determining when to get into or out of an investment. And it goes back to number 6, that a loss of money is not equivalent to a loss of opportunity. We spent almost an entire vlog going into this principle, the mathematics of a loss versus a gain. And we're not going to talk about it here, but we will do a full vlog or webinar on it again, because it's such an important principle, and why people, so many people still, now I'm not talking about investors. There's 2 classes of people in terms of investment IQ. Those that have been on Wall Street or have participated in stock markets and bond markets and real estate markets, and those that haven't and have only participated in the crypto markets. The difference between the investment IQ of those 2 groups is horrendous. On an SAT type of weighting, you would put the people in the crypto world in general at something like 200 on SATs, and people that have experience in stocks and bonds and options and real estate and other types of investments, people that have participated in that, something like a 500 or a 600. You get very few 100s and very few 800s, but it's amazing to me when talking about people in groups, that the group in the crypto world, for whatever reason, have come to all the wrong conclusions about basic principles. And that's why we teach them mainly to this group, and why so many in the group have responded to it. What we found is, though, Leah and I have found that those that came to us because of talking about the crypto world, when we started talking about these bigger principles, those are the ones that begin following us and learning the principles of overall investing, because they see how important it is to bring it back into the crypto space. But that very simple principle, that a gain of 50% is not the inverse equivalent of a 50% loss is paramount. Number 8, all long-term trends are fundamentally based. All long-term trends are fundamentally based. Number 9 is a corollary, but it's separate. All short and intermediate term trends are not fundamentally based. All short and intermediate term trends are not fundamentally based. And guess what? You can't tell which is which. And that's why it's so important to understand the difference between investments, long-term trends, and speculation or gambling on short or intermediate term trends, because you do not have a fundamental base for making your decisions on the short or the intermediate. Long-term trends are not affected by news, are not affected by headlines, are not affected by company announcements or country announcements. They are affected in the short and the intermediate term. And therefore, your probability of success goes way up as your time frame goes longer and longer. It's fundamentally based. It's not technically based. The technical tools give the same signals for short-term or hourly or 15-minute things as they do for longer and longer terms. But what you don't know is, and you cannot get, is the fundamental basis for that movement. Okay, number 10, we're getting close. Technical tools are invaluable in identifying trends. Fundamental tools are not invaluable in identifying trends. That's why technical analysis is so important. It gives you something that fundamental analysis will never give you. But remember, I'm not saying that fundamental analysis is not important. It's far more important than technical analysis. But technical analysis is far more important in identifying trends. Number 11, technical tools identify short, intermediate, and long-term trends. Number 10 was they're invaluable in identifying trends, but it's important to note that the same technical tools you use can be used on any time frame. You've got to make that decision. And what I see even very sophisticated investors doing is they let the technical tools give them a signal on the short term or intermediate term, and they believe because it's the tool that they're using that it's giving them an equivalent probability of success, and it is not. Its probability of success at the short term is less than at the intermediate term and is less than at the long term. And that doesn't matter what technical tool you're using. If it's the sequential, if it's Elliott wave, if it's hyperwave, if it's consensio, if it's what we're going to talk about this Thursday, which is a way of identifying tops and bottoms called the Selgin system. It all depends on your time frame in terms of the possibility or probability of success. And finally, number 12, the last one. long-term trends are more important than intermediate, which are more important than short. And I have a scale that I use that goes like this. You weight a long-term trend with a 5. You weight an intermediate term trend with a 3. And you weight a short-term trend with a 1. Now in chess, every piece has a weighting. The queen is the most powerful and carries its own weighting. The pawn is the least powerful and carries the lowest weighting. You can tell who's winning a game by simply counting up the weightings of the remaining pieces at various points in the game. Now, this is a very subtle point, but very important. Notice if you add together my intermediate term weighting of 3 and the short term weighting of 1, that you do not equal the long term weighting of 5. That means that both the short and the intermediate term can be going in a direction, but that does not negate the direction of the long-term trend. It's a simple way of looking at it, and I use the word in number 12, important, not simply to mean importance in terms of the weighting system, but the probability of success of each of those 3. And the reason that is important, and the reason all 12 of these principles are important, is because it tells you what form of money management you must use when overlaying what your objectives are, your time frame is, and the tools that you're using. If you're using short-term 15-minute, 30-minute, 1-hour signals, your probability of success drops dramatically, and therefore you've got to factor in where your stops are relative to that probability. When you're in a long-term trend, a 5 weighting, you don't need to use stops. When you're in an intermediate term trend, you've got to use stops. And when you're in a short-term trend, you've got to use close stops. Now, how you define that is up to you through experimentation about your own psychology. And that's another topic for another day. So that's it. It's that simple. Those 12 principles will keep you out of trouble, or will identify trouble, or will identify your human behavioral problems as you move up and down this list and you begin to do things that bother you or end up being unsuccessful. You will find, if you study these things, that you will find the things that you are doing incorrectly in terms of being able to make decisions and being able to sleep at night after you've done that. And with that, I am finished with that listing, and I want to take it back to Leah on any or all of these things.
Sure. Well, we are a little over time here, and a wonderful person in the live chat has listed them. So if you like, and I think that everybody else watching, if I could list them out, if you'd like to say if they're correct or not, or no.
Great.
All right, let's do it. And I think I missed your last ones here. Wonderful, Jeremy. 1, cash is king unless an asset class is trending up. More difficult, dangerous to short.
Right.
All asset classes trend up or down and down.
Yes. Up and down.
3, trends are short, days and weeks, intermediate, weeks and months, or long, months and years, and you can have your own.
Correct.
Only long-term trends are investments.
Correct.
5, long-term trends all contain short and intermediate counter trends.
Correct.
6, a loss of money is not equivalent to a loss of opportunity.
Correct.
7, a 50% gain is not an inverse equivalent of a 50% loss.
Correct. And very important.
8, all long-term trends are fundamentally based. Corollary, all short and intermediate term trends are not fundamentally based.
Correct.
Okay, Jeremy, I don't see your last. Oh, there we go. 9, technical analysis is far more important and valuable in identifying trends.
That's actually number 10. 9 is all short-term and intermediate terms are not fundamentally based, which is just the inverse of number 8. It's a corollary, but it's actually its own world. All short and intermediate term trends are not fundamentally based is 9, and 10 is technical tools are invaluable in identifying trends.
11, long-term trends, weight 5, are more important than intermediate trends, a weighting of 3, which are more important than short-term trends, a weighting of 1. Short and medium term do not negate long-term.
That's correct. That's actually number 12. And number 11 was technical tools identify short, intermediate, and long-term. And the reason we've got those last 3, 10, 11, and 12, 10 is technical tools are invaluable in identifying trends, but fundamental tools are not. 11, technical tools identify short, intermediate, and long-term trends. The reason that's important is you can use the same tools at any time level. But number 12 is that long-term trends are more important than the intermediate and the short term with that weighting of 1, 3, and 5. Perfect. Thank you, Jeremy. That's very helpful.
All right, I think we're off. Thanks, Ty.
Great. Thanks a lot.
Bye,
Bye-bye.
everybody.